Let's now define a put option in its formal definition. The buyer of a put option has the right but not the obligation to sell a stock at a certain price called the strike price by a certain date called the expiry date. So now this definition should sound very familiar to the call option. It's very similar except for a change in one word, and that change is the word sell. In the case of a call option, the buyer of a call option had the right but not the obligation to buy a stock at a certain strike price, whereas in the case of a put option, the buyer of the put option has the right but not the obligation to sell the stock at a certain strike price by a certain date, which is called the date of expiry. On the flip side, the seller of the put option is going to have the opposite commitment to this contract. So the seller of a put option has the obligation to buy a stock at a certain strike price by a certain date. So if you, as the buyer of the put option, has the right to sell the stock, then the seller of the put option must have the obligation to buy that stock at that same strike price by the same date of expiry. Because if you don't have this complementary relationship between the two parties, then the contract cannot be satisfied. So if one person has the right, the other person must have the obligation. And of course, all other parameters remaining the same, which is the stock has to be the same stock, the strike price has to be the same strike price, and the expiry date also has to be the same date. So buyer and seller have opposite sides of the contract even in put options, which is no different from what we saw in call options. So the only difference is put option is a right to sell. And then as we go along in this course, you'll see what that right to sell really means. And that's the great characteristic of a put option. So now what we're going to do is to recap the differences between the call options and the put options. So a call option is a right to buy. A put option is a right to sell. A call option is a bullish position. And you'll see that a put option is actually a bearish position. In the case of the call options, our break-even price was the strike price plus the premium. Because it's a bullish position, the stock had to move up to our strike price, and plus we had to add the premium there. Only then have we broken even, and after that it's all profit. In the put options case, it's actually exactly the opposite. The break-even is the strike price minus the premium that you pay. So think about the stock going down now. And when you buy a put option, you've bought a bearish instrument. So you actually want the markets to go down or the stock to go down. So when you buy this instrument, you're paying a premium for that. So it's not just enough that the stock goes down to your strike price. It needs to go down to the strike price, and then you need to subtract the premium from there. So it's actually just the reverse of a call option. So you can imagine in a call option, you're going on to the upside, whereas in the put option, you're going to the downside. And therefore, your break even actually becomes the strike price minus the premium. In the case of a call option, the stock must move up for the option to be profitable. And in the case of a put option, the stock must move down for the option to be profitable. In the case of a call option, we said that an option is in the money when the stock price or the price of the asset was more than the strike price. So if you recall the call option example, our in the money option was at the $800,000 strike price for the price of the house. And we said the $800,000 strike price was in the money because the price of the house had already gone past. So the price of the house was, or the stock price was more than the strike price. In the case of put options, it's exactly the opposite. A put option is considered in the money when the strike price is more than the stock price. Think of it as an asset, a stock that's falling. If the stock falls below the strike price, then this put option is said to be in the money. Whereas in the call option, it was just the opposite. When the stock price was more than the strike price, then the call option was in the money. In the case of a put option, when the strike price is more than the stock price, then the put option is said to be in the money. We then now look at the 4 different factors that affect option pricing. And again, this is a slide that's coming from the call options example. And that's because there's absolutely no difference in the factors that affect either call options or put options. In fact, they're absolutely the same. The 4 main factors are: what is the current price of the stock? So if Apple's trading at 500 or 525, that becomes a factor in how you price an option, because your strike price can be 600, it can be 700, it can be 800 or 300. So, what is the current price and how far is the strike price from the current price? So that's a big factor. The volatility of the underlying stock, and we took the example of IBM and Netflix in the call options course. It's the same here. If you're talking about a volatile stock like Netflix, then its ability to move around and hit certain strike prices is much more than a stock like IBM, which is generally considered a stable stock. So even in terms of the actual volatility numbers of these 2 stocks, IBM has a volatility of 15%, whereas Netflix has a volatility of 60%. So Netflix is 4 times more volatile than IBM. Apple is twice as volatile as IBM. So depending on the volatility of the stock, the option will also get affected. The price of the option will be affected by the volatility of the stock. And finally, the 4th factor is the time remaining to expiry. And this again is pretty intuitive. If you have 30 days remaining for an option to expire, and if you have 60 days left for an option to expire, obviously the option that has 60 days is going to be more expensive. And that's because there's more time remaining. So the time value is more. If between a buyer and a seller, the seller is going to demand more premium for an option that has 60 days remaining to expiry than an option that has 30 days. And if there was an option at 120 days left to expiry, that option is going to obviously be much more than the 60 days. So it's a very linear relationship. The more the time, the more expensive the option is going to be. And just like call options, we also have 2 more insignificant factors. These are the risk-free interest rates and the dividends paid by the stock. Now, both of these factors are input into all options pricing models. But in practical terms, when you're dealing with stocks in the market, these 2 factors are so small that they are not practically considered whenever you take some trading decisions. So that's as far as the factors affecting option prices. Now, this is the great part. We're going to go into a real world example to see what a put option looks like. That's the real key to understanding put options. So that's what we're going to do in the next lecture. We'll look at a real world example of a put option. Thank you.